Hello, thank you for joining me today. I'd like to use this opportunity to talk about my outlook for commodity prices, the implications of that outlook for emerging markets. I'd also want to update you on our latest views on China. There's been a lot of questions being asked about the Chinese economy with the volatile equity markets, but I think the outlook it's an improving one. And very finally, I want to share with you some thoughts on some of the exogenous challenges that face emerging markets going into the remainder of this year. We think that the worst is over for commodity prices. Important is that demand around the world for commodities is likely to improve. This is because the euro area is getting stronger and stronger. Also, the US consumer is doing better after the weakness of Q1. And finally, Chinese growth has stabilized, and we're thinking that it gets better as we go into the second half of the year. However, there will be divergences in terms of commodity prices. We think that energy prices are likely to do the best. The reason is that producers there are nimble. Also, you get producer prices which are quite close to market prices. So if market prices drop a little bit more, you're likely to see production drop. And very finally, the demand for energy is quite well diversified. Metal producers, on the other hand, they're likely to face a more difficult time because the source of demand comes from China. As a result, we're a little bit more cautious on copper, iron and steel. In emerging markets, the key countries which produce copper, iron and steel, the countries which are going to be a little bit more vulnerable, include Chile, Zambia, Mongolia. Amongst the energy producers, the ones which should do better are going to be the ones with good economic policy. That means Colombia, that means Mexico, that means Indonesia. Also, some of the countries which have strong balance sheets and are commodity producers, energy producers, will do okay. Russia, Azerbaijan, Kazakhstan. With this outlook on commodity prices, there's likely to be winners and losers in emerging markets. The countries that are likely to do better are the energy producers, particularly the ones where policy has been run relatively well. We think this includes the likes of Colombia, Indonesia, and also Mexico. There'll also be countries which produce commodities, sell energy commodities, where the balance sheets are quite strong, and those will also do well. That includes Kazakhstan, that includes Azerbaijan, but also Russia. Those who are going to be hurt in this outlook are going to be the ones where they're concentrated on metal production, in particular copper. Those ones are going to be dependent on the construction sector in China, and I think the outlook there is going to be quite cloudy. Economies which are going to be sensitive to this are Chile. They also include some of the smaller EM economies, which include Mongolia and Zambia. And what about China? We think that the Chinese economy is going to be picking up. We've seen some signs that Q2 was better than Q1. And also, the government and central bank has done more to support growth, with interest rate cuts, more spending, and support for the local government. This is likely to provide momentum into the second half of the year. However, the complication is the equity market, which has been very volatile in the last couple months. The government has started to take action to support the equity market, but we don't know if it will work. The equity market is a risk for the Chinese economy, but in our view, not a big one. Emerging markets faces some exogenous risks, exogenous challenges going into the remainder of the year. One is going to be the Fed when it does start to hike. On this note, we think that emerging markets can be a bit more relaxed. The reason being is that in the last couple of years, there hasn't been a strong surge of money from the US to EM. Therefore, when the Fed does start to hike, and we think it's going to be a gradual hiking cycle, it won't lead to money leaving emerging markets. The second exogenous risk, which we're monitoring quite closely, is the effect of Greece on the rest of Europe and what that does to emerging markets. The main channel of contagion there is likely to be what does Greece do to business confidence in Europe? What does that do to the demand for goods from emerging markets? And that's something that's evolving as we speak. Something that will make emerging markets, understandably, quite exciting. Thank you very much for spending time with me today. I hope to talk with you in the near future about emerging markets and other key developments. Thank you and speak soon.